Good morning, everyone. The opening bell has rung about 2 minutes ago. I'm joining you on this fine Wednesday morning. It's the last day of February, so this is the day that the indices, the U.S. equity indices, have to post pretty big gains today if they don't want to show a decline month over month. Not likely that's going to happen. As I mentioned, the written Trader's Espresso was out and published. The video edition will be accessible shortly. But one of the things I mentioned is I don't expect a lot of excitement today. I don't expect a lot of action. I don't expect a lot of volume because there is so much data coming out tomorrow. And Chicago Purchasing Managers Index. There's some more, inflation data coming out. There's, Jerome Powell is now going to testify before the Senate. He was at the House. He went before the House yesterday, and some of the things that he said kind of roiled markets a little bit. What was interesting is the fact that what he said seemed to be a lot more hawkish than the testimony, the text of his prepared testimony, which was released about an hour and a half before he appeared. What the text that was released sounded a lot more like just the minutes that had come out. It sounded like the boilerplate that they modify from month to month. Because yesterday was a question and answer session, there was a lot more pointed questions that were asked, and Mr. Powell had an opportunity to expand a lot more. And, he went in a direction that indicated that things are just a little bit more hawkish. So the Dow closed down yesterday, for example, almost 300 points. The Dow's up 112, the NASDAQ 100 is up 35, the Composite's up 34, the S&P's up 11, the Russell's up a little over 6. The yield on the Treasury is at 2.883. I think it's off of its lows of the day. The dollar is up 14 basis points, so that's about where it was last time I looked at it. Gold is up. It's firming. It's up $3.40. That's 0.25%. It was barely up when I looked at it maybe 15-20 minutes ago. So yeah, it's going to be a pretty interesting day. Interesting not because of any excitement from trading, but more just interesting to see what these indices do on low volume. Are they going to show month-to-month declines? How's that all going to shake out? Again, like I said, there would have to be a pretty powerful rally today for there to not be a month-over-month decline and for there not to be a bearish monthly stochastic crossover on the Dow, the Russell, and the S&P. The NASDAQ and the Composite are not in danger of a crossover for February. There's declining momentum, and I'll pull the charts up in a little bit to kind of point out what I'm talking about. NASDAQ futures now showing some weakness. Sorry, folks, I'm going to be a little quiet. I'm doing some stuff off to the side here. Yeah, I don't know. I mean, looking at this is the NASDAQ 100 futures. You know, I don't know how long this bullishness is going to last. This morning, anyway. I mean, the reason why futures were already up, and then they got a little bit of a lift when the data that came out this morning at 8:30 Eastern Time was a little mixed. You know, the numbers were either at consensus or slightly below. So, you know, not bad news is good news, apparently. Which, in this environment, good news is bad news, like the economy is growing, but everyone is so afraid of the Fed tightening that good news isn't good news, it's bad news because, you know, we don't like that the punch bowl is being taken away, even though we're kind of at the tail end of the party. Because there's a lot about the data that's coming out that if you compare it to kind of the classic definition of a late economic cycle, you know, matches. Those things match. Things like inflation, things like rising interest rates, things like consumer optimism, you know, not that that's bad, but I don't know if I would necessarily say that consumer, excuse me, consumer confidence is irrationally exuberant. I think that there are some cracks, you know, in some softness in new home sales, some softness in durable goods purchases, you know, could potentially be a reaction to higher yields, which is a precursor to high, well, not even a precursor, I mean, rates are higher, you know, mortgage rates are higher, you know, auto loan rates will be higher, um, you know, that sort of thing. Although I wouldn't take the short now. I mean, there was a short opportunity, you can see that. Um, I wouldn't take it now because of this. I mean, unless you're willing to ride, you know, your position to a loss before it turns back in your favor, which I generally don't like to do. So a little bit of recovery here. You know, that's this strength here in the 1 minute chart. You know, we're seeing a bearish stochastic crossover forming on the 15-minute chart. So if there's continuation, we'll see that we're seeing weakening momentum on the 1 hour chart. Emerging markets up. The VWO anyway up, 7 cents right now. Facebook posting a little bit of a recovery today, up 55 cents. It was down $3 and change yesterday. Yesterday was a pretty hard fall for U.S. indices. it doesn't really surprise me these markets are up. I mean, after yesterday, like I said, yesterday was a pretty bearish reaction to Jay Powell's testimony before the House. And I don't know if he necessarily said anything new, but it was the fact that he came out and said, because he was asked the question, or he was asked a question to which this was an appropriate response, but the members of the FOMC need to take a fresh look at the rate path that we're on, because the data, what we're looking at today, a lot has changed since January, since December. So yeah, this is okay. This is a very powerful reversal here. It's changing the picture clearly in our stochastics. Chicago Purchasing Managers Index may have something to do with it. I can't see the number right now. What I can tell you is pending home sales are just about to be released in about 3 seconds. So if I had to hazard a guess, I would say the Chicago PMI probably came out softer than expected. The consensus last number was 65.7. Consensus was for 64.2. I would bet you that it probably came out softer than 64.2. To see this rally, which started, right at 7:45. It started with 7:47, so 2 minutes later. I mean, the number may have come in on point, on consensus. Yep, that's exactly what happened. Chicago PMI drops to 61.9. It was 65.7 in January. The consensus was for 64.2. So the numbers which show that we're growing softer than people are expecting are lifting the market up, because that whittles away at the chance that the Fed, when they take a look at things, will decide that they need to do 4 rate hikes this month or this year instead of 3. So now we're seeing profit taking. So all in the first hour of the market, half hour. Starting right here. This is why I will often say, it's a good idea to let this market trade a little bit, whether it's the first 5 minutes or the first 15 minutes. You know, in this case, having known the data that's coming out, the Chicago PMI coming out at 745, you know, would not want to be in a directional position until that number comes out, or have tight stops in place. But even stops aren't necessarily going to protect you. You're not going to get executed at your stop price. Once it hits that price, it'll open a market order, and if it's trading against you, you might lose 10 ticks. I've had that happen before on trading crude oil futures when a inventory number came out. Which, by the way, EIA data comes out in about 26 minutes. API showed a build of 933,000 barrels. They don't publish a consensus number on that, but the last week it was a draw of 907,000 barrels. And so that number coming out at 2:30 Eastern Time, or sorry, 4:30 Eastern Time, was here. So even though the number showed a build, there was probably some whisper number that wasn't hit. You know, should have been a 2 million barrel build or something initially. let's take a look at how sectors are doing today. Up across the board, IT is the strongest, followed by financials, consumer discretionary, energy, and telecommunications. Real estate, the weakest is consumer staples and healthcare. Surprisingly, utilities are doing well today. I was going to look at monthly charts. So this is what I was talking about earlier, where the Russell, the Dow, the S&P are all forming a bearish stochastic crossover. This bar closes today. This is the February. Each bar is a month. This one closes today, which means this will close today. So unless we see a huge rally, I don't expect that to change. Same thing on your Dow. Oh, that's the S&P, I'm sorry. This is the Dow. If you compare, the stochastic histogram to the relative strength index, the RSI, they tell a very similar story. Okay, I'm not sure how many times I have to click on S&P to get the point across. As is the S&P, as will be the Russell. The only wild card is going to be the NASDAQ and the composite and the 100. I mean, they'll probably still show overbought. I think that's what I said here, overbought, instead of oversold, overbought. Maybe if I type it in manually. Of the three indices that we just looked at, the Russell's the only one that's actually crossing below the 70 threshold. That's where that is generally considered, as a correction is beginning. Same thing if it were oversold, it crosses above the 30, that would say a rally is beginning. That would be taken as an indication that a rally is beginning. If you look at the NASDAQ 100, which has shown greater relative strength compared to these other three indices, The NASDAQ index is showing, yeah, I'm oversold. I'm going to continue to be oversold or overbought. I don't know why I keep saying that. I'm overbought. I'm going to stay that way. And we're seeing deteriorating stochastic histograms here, but not an imminent crossover yet, like we are with the S&P and the Dow and the Russell. So this is a mess that we're going to have to clean up. You know, decide what's important to stay on there, what's not. This one's still important because this one has not been broken yet. Notice that the NASDAQ futures traded up here twice and retreated twice. So now we just broke up above this trend line that we just drew. This yellow dashed line, this is the midpoint of yesterday's range. There's a study called pivot points. There's certain ratios that have been developed that over time they, based on the price range and the midpoint, etc., that are, potential levels of support and resistance. So this green one is the first level of resistance. But before it's going to trade up to this area, we're going to see what it's going to do here. This move is happening on volume that's already above average. I mean, obviously it's a lot less than these two bars, but it's a 4-minute bar. No, it's a 15-minute bar, I'm sorry, that just formed 5 minutes ago. So it's still got 10 minutes of activity left in it. So we're prepared to trade crude if we see some kind of a setup. Seeing some weakness in the NASDAQ 100, and if I'm really honest with myself, I don't like what I'm seeing here. This tells one thing, the 1 hour chart, but it's expended a lot of momentum getting up here. I think the net right now is, given the data that's coming out, I'd probably rather be long of this than shorted it. So what that means is, if you're going to short this market when you see an opportunity like you do here, realize that you're going to be going against the prevailing trend. The prevailing trend right now is up, it's not down. Now, just kind of, at first blush, I mean, this is a 4-minute chart here, but drawing a trend channel tells me this is the trend channel here, and the NASDAQ 100 is traded out of it, fell back in, and is trading outside of it now, and is headed back towards that level. So I revised that statement. I'd say that you will be trading against the trend when you're back in here. Right now, bearishness, down price action is basically just normalization. It's a reversion to the mean, which is right here, this green line in the middle. And I know that this is a lot of noise here, so let's just try and clean things up a bit. That's a little bit easier. So now the guides that we have to go off of are moving averages, which this is the 9. This is the 27. This is the 81. This is the 243. And I might just take the call on these: the 9, the 25, the 250, the 75. And we're less than a minute away from crude. And crude's dropping, selling off. Technically, the numbers shouldn't be out yet, but somebody's got some inside information. Perhaps, hate to say it, it does happen. You've seen the movie 48 Hours, or not? You've seen the movie Trading Places, right? So I'm going to let this crude kind of figure out which way it wants to go, and I'll be right back. Huh. EIA showed a almost 2.5 million barrel build. Consensus was for a 2 million barrel build. The API number yesterday showed a 1 million barrel build. Those numbers are generally off. The EIA number is the one that most people rely on. That doesn't mean people don't trade on the API number, because they do. They'll trade around it. So bigger build than expected, bearish for crude. That means more inventories. That means that the shale producers are not flooding the market, but they've definitely been giving OPEC a run for its money in trying to stabilize oil prices. I mean, OPEC has been successful in doing so. They've gotten oil back above $60 a barrel. You know, if you look at a week chart, when it's been over a year, it was late 2016. Maybe it wasn't that, it might have been mid 2016. I think it was right around here when OPEC announced that they were looking at production cuts. So they brought it up from 40, $45 a barrel up to 60. Now Goldman Sachs, this was about a month ago, their 6-month price projection for crude I think was 82.50 a barrel. It might have been 87.50. It was one of those handles. I think the play today on crude is bear. Looking at the way stochastics are shaping up right now, it was already like that before the number came out. So really it's just a question of when to get in, getting in with good trade locations so it doesn't have a chance to go against you. This is slowed down. Not a lot of volume now. I'm not in a hurry to get in at all right now. And I really don't have a lot. I'm only in 2 positions right now. I'm in a bullish put spread on Facebook, and I'm in a bullish call spread on VWO, which is the emerging markets. And yesterday I was looking at the chart on VWO and trying to figure out, I'm long a January 2019 expiration 26 strike call, 3 of those contracts. I'm short a March expiration 46. It's at 47.80 right now. If expiration were today, I'd probably be assigned. Or if it were expiration week, I'd be shocked if I wasn't assigned. that line I just drew happens to be a level of support from Friday, which happens to be right around where this first pivot, this first support level is. And this other support level, which is from the 22nd, Thursday, happens to be where S2 is. So this, chart drawing isn't just quackery. I mean, it's, markets have memory, and a lot of times you will find uh, some agreement when you just eyeball a chart and you see natural levels of support and resistance. Oftentimes you'll find that it happens to correspond to maybe pivot points like we just saw, or Fibonacci retracements. I want to see what it does around this pivot point here. I know I said I wasn't in any hurry to get into it, but my look at the stochastic charts tell me that this isn't getting better anytime soon. Although, call me a liar. I mean, that's what it's doing right now. Waiting to see here if sellers can get enough together to overwhelm buyers. Right now, as you can see, it's, sort of a state of equilibrium. And just got stopped out. So let that be a lesson to you kids. Generally, your first instinct is the right one. I don't generally like to play counter trend rallies. This one was looking a little bit more interesting to me. Although right now it's showing a little trouble getting started. Maybe this next bar will do a little bit better. Nope. Still too weak. So there you go. 2 rules I violated. Didn't listen to my gut. And I tried to play a counter trend rally. Lessons like that are good though, because they tell you that those elements of your trading system, that there's some validity to it. You know, it's difficult when you're trading a trading system that's not tested, like you haven't had the chance to test it yet. How frustrating is it when the price comes down to where you've got your target, it just teases you. It doesn't, you know. It's like, just get there already. You're going to eventually anyway, so. Just do the right thing. Oh, screw it. Ridiculous. What has made this so difficult? As far as getting good trade location is concerned, is just this persistence of staying down here and some false starts that made it look like, okay, this is a bearish or bullish rebound. You know, we'll get our opportunity to short, and then the bears just smack it down again. So if we can see, you know, some kind of a rebound up here, that would position us well for a short. hard to say precisely where, but, and I know that's a big range. However, right now it looks like it's getting stuck right here at this, support level, which was support. Now it's resistance. Spending all this time watching crude, we may be missing out on what's going on in the NASDAQ or any of the index futures. Although looking at it now, I have a feeling like we may not be missing all that much. Well, here's what we are missing. In spite of the cheer that stock traders, equity traders, investors tried to derive from the mixed numbers, I mean, this is what we're seeing, just dramatic selling, back into this channel in the case of the NASDAQ, because we drew a channel for that. I just caught this headline: U.S. pending home sales gauge falls to the lowest since 2014. So that was one of the pieces of economic data that we talked about, that I mentioned in the blog post that was coming out today. Now we know that Chicago Purchasing Managers Index came in worse than expected, which the market rallied on that. Pending home sales were month over month. Consensus was for a 0.3% increase. The numbers show a negative. So the numbers show a 4.7% decrease. Year over year, there was no consensus, but the previous month year over year number was a 1.8% decline. This month, on a trailing 12-month basis, posted a 1.7% decline. Now that pending home sales came out at 8. So that was right here. So a little bit of push-pull between 8 o'clock and 8:30, and after everybody's had a chance to digest the data, they realize, uh-oh, I mean, this is, and I don't know that I would say, I mean, if I had to guess what people are thinking, what they're thinking is probably like, we're behind the 8 ball. Like, the tightening is already having an effect. Bond yields are having the spike in bond yields is having its effect. It's curbing consumer spending behavior. Durable goods was down. Durable goods spending is down. Home buying is down. And that's not just bearish if you're a home builder, right? Or a mortgage lender. That is a barometer of the overall economy, because if you take a look at what is happening in the late stages of an economic expansion, it's inflation, it's increasing real estate prices, and not that real estate prices haven't been increasing, because they have been, but this piece of data comes out saying we may be at a top. We could very well be at the top of this price expansion in real estate. From a residential perspective, none of these numbers I've been talking about are commercial. Generally, commercial is, my observations are, it's about 3 to 6 months out of phase. So that was a nice catch right there. Probably should have stayed in it. But it at least helped reverse half, well, I shouldn't say that. It reversed my crude losses. I had $100, I was down $100 on crude. So if I'm up 205 on the NASDAQ, that means I'm up 105 minus transaction costs. I don't know what I'm not going to calculate transaction costs, but 105 is my gross gain on my futures trades today. My Facebook position is up a paltry $5 today. FB, the underlying, is up 8 cents, 13 cents now, 12 cents. So be careful what you wish for, because you just might get it. And I'm saying that because the initial reaction to these numbers coming in softer than expected was, oh, whew, thank goodness. That means that Jerome Powell and his banker buddies don't need to raise rates, so dramatically. But then these numbers come in and people are like, oh, wait a second. this isn't just data coming in soft, like this is bad. It may not have anything to do with the Fed. It may be the bond market that's our biggest enemy right now because of where 10-year yields are right now. I mean, the benchmark for mortgage rates in the mortgage industry is the 10-year Treasury note. So according to Mohammed El-Arian, who I have a lot of respect for in terms of his knowledge of markets, 6 takeaways from Jerome Powell's testimony yesterday. Headwinds have shifted to tailwinds. So basically our economic expansion is occurring within the context of a wider global expansion. Point 2 is all it's really saying is we're not going to back off on the need to pursue a monetary policy of gradual tightening. That's all that's saying. Now, one thing that kind of leaves a bit open is the idea that the yield curve is flattening, which it is. It sounds like what he's saying here and what Mr. El-Arian is saying and interpreting this is that the traditional explanation or the traditional meaning assigned to a flattening yield curve is that it portends a potential recession. It sounds like what Mohammed El-Arian is saying here is that his interpretation of Jay Powell's comments are that don't be so quick to rush to that judgment that, you know, rising rates at the short end of the yield curve are choking our growth. But here's the problem. We're seeing evidence that that's the case. I mean, the numbers that just came out today. So point 3 is about the regulatory role. Now, I would have to go back and read his comments. I don't remember having paid a lot of attention when this discussion was on the table, but what I can't tell here is Jay Powell saying that we need to revisit some aspects of tighter financial regulation because we think the financial regulations are too tight, or we think they're too loose, or just they could be better? And I know, point 4 here, I noticed this yesterday. I found it kind of humorous. I tweeted out that despite the best efforts of some members of the committee to paint Jay Powell into a political corner, he's stuck to his guns in terms of not commenting on issues that are outside of the purview of the Fed. If you want to politicize the Fed, then introduce some legislation to do that. But to grandstand on national television in your committee and to ask questions like that is just in very poor taste, in my opinion. Asking him questions about, which basically, like, you're not asking a question, you're making a statement. Everyone can tell that what you really want. The answer that you're angling for is for Jay Powell to come out and say, yeah, I think that Trump, the administration's stupid, with these tax cuts and the inflationary fiscal policy, because all they're doing is they're making it so that I have to raise rates even more. He's not going to say that. Yeah. He's not going to weigh on DACA. That's immigration. That's an immigration issue. It has nothing to do with monetary policy. You could argue that, yeah, it has something to do with the economy. I won't disagree with you there. But, I mean, if you really want to expand the role of the Fed, I think you're going to meet a lot of opposition there. Now, this thing about exchange-traded funds, I mean, what Jay Powell said was, I can't remember exactly how he worded it, but that ETFs basically were not to blame for the recent volatility. When he says ETFs in general, I'm pretty sure what they're talking about was those short volatility ETFs that basically imploded and wiped some people out. So that's my 2 cents. So what we missed while we were reading Mohamed El-Arian's piece was a rebound back up into channel and trading up almost to the midpoint, and now a softening from there, declining moving averages, you know, the 9 period crossing below what I'll just call the 75, the 25 crossing below the 250. You know, stochastics, which tell us another bout of selling, potential bearish stochastic crossover on the 1 hour. We've already seen it on the 15-minute. Signs of improving, although not really on the 4-minute. So kind of what I might expect to see here would be a bounce, a reversal in this trend, in you know, improving histograms. And actually, I've just missed it. Like, it didn't close yet, but you can see it's brighter red, which is an indication of declining momentum. Volatility increasing. I haven't looked at VIX and RVX yet, but I mean, you know, VIX was up almost 20% yesterday. It's up 1 3/4. The RVX is up almost 3. So the Russell's the one getting hit. The Dow is too, but not. I mean, the Russell's down 0.3% on the cash markets. Whoa, hold on. In the futures, all but the NASDAQ futures are down. S&P futures aren't down by much. Call them flat. Russell down 0.4%. The Dow down 11 points. I mean, on the futures down 11, 12, 13 points. You know, that's 0.05 to 0.06%. The VWO was down 15 cents. Helpful for me because it means I can buy my short call back cheaper. I haven't decided whether I'm going to buy it back outright. It depends on if I think the prices are going to rebound, then I might buy it outright. If I think that there's continued softness, then I might just roll it to a lower strike and turn it from a bearish call spread, which means I'm long premium, to a bullish call bearish call spread, which means I'm actually short premium, like I'm a net collector, I'm a net seller of premium. Let's check in on crude. Has crude made up its mind? So it looks like it has. It made up its mind to continue to the downside. It hit this level. Oh, you're not even seeing it. Hold on, let me move the graph. So I think we abandoned watching it around here, but it has resolved to the downside, and it traded down to this level of support, which I had marked on the chart that is, I believe, coincides with a pivot point. Yeah, it does. So it coincided with S2, so it bounced off of S2. Bounced off initially off of the first level of support that I had drawn on the chart, which extends back to Thursday, so right here, with another level of resistance and support just right below it. So the next short trade on crude will be if it breaks below, which it's trying to do right now. Will it trade down here, which it probably will, but then what? So the next, from 61.75 to about 61.57, next level of support would be about 61.39, 61.40, which I just added here. That is, you can see resistance support here. That's a good level. Below that would be right there. And then honestly below that would be, I think, right here. I mean, there might be a pause here, but curious to see where value area is developing. Obviously lower. Where NASDAQ is trading, it's spending a lot of time here, which, I mean, that's the definition of point of control on a volume, on a time profile, is where it spends the most time. But I think what we're seeing here in terms of actions bearing that out. If I had to predict, I predict NASDAQ futures trading down to the bottom of value, to the lower end of value area at about this 6,900 level. Okay. That was a little bit of a scary reversal, but it got batted down pretty quickly by the sellers. Okay, let's just stop playing this game, shall we? Oh, and I just looked down what time it is. It's 9:36. So, lunchtime on the East Coast has begun. Cash markets, Dow's down 30, NDX is up 15, Composites up almost 10. S&P's flat, Russell's down 4. With the exception of the NASDAQ futures, the futures are down, index futures are down. Volatility is up. Volatility futures are up 4% compared to 2 and 2.3 on the VIX and RVX respectively. The Dixie, which is the dollar index, is up almost 0.2%. Gold's up, crude's down on soft inventory numbers, and the market right now is deciding whether or not it wants to regret wishing for softer economic data. So, enjoy your lunch, and I'll see you at about 1:30 Eastern Time.